Welcome to the Risk Reversal Podcast. The voice you hear is Guy Adami's. The voice you're about to hear, the one you're actually here for, is Elizabeth Thomas. She of SoFi. E.T., how are you?
I am great. E.T. You haven't used that very much, E.T.
Well, it was EY from SoFi, and
I'm
then it
fine
was
with it.
EYT, now it's just
I
ET.
know.
You're like, there was a period of time where it was John Mellencamp, then it was John Cougar, then it
That's
was
right.
John Cougar Mellencamp, then he's back to John Mellencamp. I'm just
Yeah.
saying. And he's from the
There,
Midwest as well, as
there
it
are a lot
turns
of
out.
people that went through those things, right? Kanye went through that. He was Kanye. First he was Kanye West, then he was just Kanye, then he was just Ye.
Sure.
Now he's, he's a
Now I don't know
different
what
name.
he is. Well, I mean, that's
A different four-letter word, perhaps.
neither here nor there. Your Packers of Green Bay continue to impress. The
Mm-hmm.
Brewers lost to the Dodgers are just a juggernaut, as we were discussing prior to. Shohei Ohtani is doing things that do not make sense in this day and age, but I
It's wild.
digress.
I mean, I am terribly disappointed, and it was tough to watch all four of those games. So I'm sad for not being able to advance to the World Series, but I am also really, really happy for the Brewers for having such an amazing season and for being such a small market, scrappy team.
Mm-hmm.
All year they had been called the above average Joes, and somehow put it together, that team of above average Joes, to create the best record in baseball. So
They
it was a
did.
wonderful season to be a part of as a fan. Of course, we would have liked to go all the way, but still happy about what happened thus far.
Then that's what, and that's why you're the sports fan you are. And I know you have not seen The Godfather yet, which means you probably haven't seen Godfather
Maybe,
2
but
yet.
how about by the end of the year? I
Well,
will
it's
do
October
that.
20th,
I got
Elizabeth. So
time. I got
not
time.
a lot of time,
It's a
but
long
okay.
movie,
If
right?
you make me that promise, then okay, we'll talk about it. But there's a scene, excuse me, in Godfather 2 when Michael is in Cuba with Hyman Roth and a bunch of people, and Michael says, "I saw something earlier today," and it talks about, he saw how the basically the rise from the people, how they could defeat the government, and he took that and he's like, this is interesting. So I saw something last week, and that something I saw as a volatility index on what was a down market day, granted, but historically somewhat benign day, spiked above 25. I think it was on the 16th of October. Now the VIX is back down. I bring that up because to me, I saw something, and maybe that's a harbinger of things to come. But you were talking about it, and the things going on in the credit markets on the private equity side that I don't want to say are giving you pause, but it's clearly something the market's trying to sniff out.
Yeah, so I think there are two big things going on here, one of which was happening before many of these headlines. So you're referencing some of the stuff that came out last week and actually began the week before. There have been sort of a culmination of headlines now that have gone on. And we've got, I believe, 5 announcements. I might be off on the count there. Some of them are intertwined, right? The bankruptcies of a couple non-financial firms, First Brands, that then bled into financial firms. So they all became sort of interconnected. Many of those were fraud related, but there are others that, there just wasn't any collateral, and maybe that did begin with fraud. In any event, it bled into the traditional financial system. I make that point to say traditional financial system because one of the things that comes out of a financial crisis is more regulation in order to try to prevent another financial crisis of that same type, right? This is why we talk about history rhyming, not repeating. We've probably had regulations that completely prevent it from repeating in its entirety. And that is what happened after 2008 and 2009. Lots of regulations that put more restrictions on banks for the loans that they could issue and their underwriting standards. We know all about the reserves that were required, all of that, the too big to failness of everything. So what that did, though, instead of just preventing the loans from being made, is it pushed non-bank institutions, less regulated institutions, into making those loans anyway, right? Somebody's going to do it. It's going to happen. And I'm not saying that that's necessarily something wrong with the financial system. It just is going to happen. We talk about this during lots of different speculative periods. There are always going to be elements of leverage that are increasing during highly speculative periods. That's what we're in right now. We're in a speculative period. That's no secret to anybody. So now, because the regulated entities haven't been able to make those types of loans, other non regulated or non bank financial institutions, NBFIs, new acronym, are the ones that had been making those loans. So intertwined in all of this is that private credit became a popular way of financing things, and they're getting wrapped up in some of this. What makes it more tricky is, as we all know, when it's private, it's not mark to market on a daily basis. We don't have a lens into what's going on every single day. And the mark of what securities are worth is basically in the eye of the beholder, right?
Hmm.
So there's really no way to figure that out. And over time, that hadn't been such a big problem because there were lockups and you had to be an accredited investor and all of those different things. But now the democratization of investing has opened up all of those private markets to other investors. And this is feeling a little bit closer to home, I think, than people would prefer.
Yeah, I agree with that. And now the next question, obviously, and the question that market participants are asking is, is this a systemic thing or are these a series of one-offs? I know a bunch of different people that have different views on this. I don't think it's systemic in so much as one of these things can take down the sector. I think it's systemic in so much as a lot of people are doing it. And I'm not trying to be nuanced here, but that there is a distinction.
Yes. So, and I do agree, a lot of people are doing it. That doesn't necessarily mean that the whole thing needs to come down. If there are layers upon layers like there were in the financial crisis, we certainly don't know about them yet. I don't think that's the case here. We're talking about auto loans in many of these and some other types of loans that basically were unsecuritized. So it's different than the mortgage crisis. I don't think that we're dealing with something like that here. I read a tweet yesterday, so I'm not going to claim this as my own quote, but it was something like, we've had 5 or 6 announcements now. You can call those one-offs, or you can call those idiosyncratic events that are contained. Once you get up to that double digits number, if you've got like 10 events that have come out in a short period of time, it's hard to say that 10 events aren't some sort of culmination of a theme that's happening and likely to get bigger. So if we keep hearing announcements like this that smell the same, look the same, then we probably need to perk our ears up a little bit more and figure out where all of the exposure is and how much contagion that could actually create. Of course, if you look at it from a really negative point of view, you could say, well, if private equity and private credit is taken down, then you've got all this AI funding that's on the hook. There's a lot of different ways that the house of cards could come down if you get really pessimistic about it. As of right now, everything I have read has said that this could be contained and that these were events that were separate. The only thing I would add to that as sort of an optimistic view, and this is something I learned during the SVB and regional bank crisis back in 23, is that we don't hear about it, but on a regional bank and community bank basis, stuff like this happens all the time. It
Right.
just doesn't make the headlines. And a lot of times when there is stress in the system or people are looking for a reason to be stressed, this stuff will then make the headlines. But in reality, it's happening under the surface anyway.
All right. So, you teed me up nicely as you typically do. You mentioned these small and regional banks. So, again, I'm not suggesting this is the best constructed ETF, but this is one that people look at, and it's the KRE, which is the regional banking ETF. And this is an ETF that made its all time high, I believe, in January of 2022, either side of $80. As we're sitting here today, it's trading about $60 with, it's bounced off the lows in early 2023, but clearly, I think we can all agree, vastly underperforming its bigger peers and obviously
Yeah.
vastly underperforming the broader market. I bring that up in the context of a couple things. If the environment is so robust for the bigger banks, it stands to reason that if M&A is going to be a thing and if the economy is starting, one would think that these banks should be trading a lot better than they are, yet they're not. And I think one of the reasons are the way we led the show off, but there are clearly other things going on here as well. So just thoughts on the relative underperformance.
Yeah, I think a mistake that many of us have made is talking about financials and painting with a broad brush over these periods and saying, net interest margin was going to improve, deregulation was a tailwind, and just talking about it as if financials as a sector broadly was going to benefit. And let's keep insurance out of that. So I'm just talking about financial firms. We've got diversified financials, we've got banks in there, we've got a lot of investment banks that are not necessarily leading with just consumer banking. And then obviously you've got these smaller banks in there. There was another chart that I saw. It was either in a note last week or early this week from Tony Pasquarello.
Mm-hmm.
And we hear all the time about the K-shaped recovery or the K-shaped economy that we have in the United States. And that's usually talking about income levels of consumers. So upper level consumers still spending, responsible now for 50% of consumption. We all know this story. There is also a K-shape taking place in investment banks versus regional banks.
That's right.
And if you just do a normalized chart of the performance of those two groups, you've got investment banks up and to the right, regional banks down and to the left. It's pretty clear. So there's clearly something bifurcated about the financials industry. If this bull market is to continue, and if the cyclical part of the economy is still healthy, we need to see those regional banks confirm that. I talk about things like that a lot. We've talked about, the transports confirming a move in the Dow. That's kind of an old school way to look at things. Small caps need to confirm cyclicality in the economy or confirm movements in large caps. In this case, I think we need regional banks to confirm that cyclicality in the financial system is still intact. And we have not seen that yet.
No, we haven't. And, we're seemingly a long ways away from it. And again, if you had told me all the things that would transpire over the last 8 or 9 months, especially, the hope for M&A, we saw an M&A deal with Fifth Third a couple weeks ago, how well the bigger banks have performed, obviously how well the broader markets performed. I would have said, these regional banks have to be almost by definition doing well, and they're not. So your point, you always bring up relationship problems. This is just, I think, add this one to the list of the relationship between the bigger banks and obviously the smaller and the regional banks. And I think it's something to watch. You mentioned we started the show with leverage, and I read an email from Doug Cass, and this to me is concerning. The number of leveraged equity ETFs are at a record high. There are over 700 leveraged ETFs now. For context, I would say, 15 or so years ago, there were probably 120 or thereabouts. And, now you're starting to see being listed 5x levered ETFs in AMD, Coinbase, Oracle, Google, Palantir, Bitcoin, you name it. There are probably 20 different things. And, I guess leverage is a great thing on the way up, but it's a double-edged sword when things start to go pear-shaped. And, I read things like this and say, my God, this is, again, I think this is sort of late market cycle stuff that we're looking at.
It's definitely late market cycle stuff that we're looking at. The trouble is that we don't know how long late cycle can last. I mean, we've been talking about late cycle, and I am absolutely guilty
I
as
have been doing
charged at
it
the
for a
top
couple
of
of
this
years now.
list.
Yeah.
Yeah, I am at the top of this list, guilty as charged, saying late cycle. This is the longest late cycle I've ever seen. Leverage is a conversation that is starting to pick up steam right now. I think people have been talking about it a little bit here and there, but it's picking up steam because it's starting to show up in the data and it's starting to show up in the headlines. So it's not just the levered ETFs. That's, I think, an indication of risk appetite and people trying to fit their risk appetite to what the market is doing. And that's not how it works. You should choose your risk appetite first and then execute in the market. So there is some speculative risk taking that's happening. But again, that happens all the time, especially late cycle, especially during an optimistic period. People are going to stretch their risk budget. So that is happening right now. Levered ETFs are emblematic of that. There are some other things going on with leverage. We just talked about private credit. There was a chart that came out last week that made the rounds very, very quickly about margin debt
Yeah.
hitting a new all-time high. Now, you can refute this by saying, well, the market cap of the entire stock
It's
market
bigger.
is larger now, GDP is bigger, so on a percentage basis, blah, 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 blah. I don't care. It's at a new all-time high. And you've got margin debt that continues to grow. I'm looking at the chart right now, and I showed it to my husband, and I said, usually you don't want to see a debt chart that moves up and to the right. And that's exactly what it's doing. So what it does is it creates more fragility when things get shaky or something happens or an unwind takes place very quickly. It's charts like this that have created fragility and the propensity for a sell-off to just get faster and faster and faster and faster. And that's why you just can't catch it if and when it starts happening. I'm not saying it's going to start happening, but there are some of these warning signs. The other thing that I'll say that's going on in the sort of leverage and liquidity market is that there are some indications that liquidity is drying up. We know that QT is going to come to an end at some point soon. I think it's going to come to an end sooner than people expected. And there are some indications out there. I put a big tweet thread out this morning on this if people want to really get into the nitty gritty on it. But some indications, rate movements on some of those little esoteric rates that nobody really ever talks about, that are indicating there just isn't as much liquidity in the system. Banks are feeling a little funding pressure. Some of the rates that they lend to each other by are changing. So there's not as much cash available, and bank reserves are no longer in this abundant territory. They're now in ample territory, which is not a problem, but it's ample. It's not abundant. We were in abundant for a very long time, and the repo facility is drained.
I love the difference between abundant and ample. I guess that's sort of in the eye of the beholder, but I digress for a second. So let me let me bring this up as well. We're talking about some of the fragility. What we're seeing some stability in, though, is the bond market. And I think
Uh-huh.
some of it is potentially global bonds have seemingly calmed down for a period of time, which is a good thing, by the way. I want to be clear. I think when the Fed announced their balance sheet reduction was going to, I don't know the exact language they used, but they talked about sort of slowing down that process or stopping it altogether. I think the market took that as an encouraging sign for the bond market as well. So as we're sitting here right now, probably have 10-year yields below 4%, the lowest we've seen probably since the Fed rate cut day. And prior to that, obviously we got down to I think 3.6 or so in that huge sell-off earlier in the year. But rates are tame, I guess, is my overall point. So you can take some, I guess, some solace out of that.
Yeah, rates are tame. And one of the things that didn't happen last week when the VIX index spiked is that the move index didn't spike. The move index didn't really respond. So for a long time, remember we had gone through those days where treasury yields were swinging 20 something basis points on a day. That did not feel good because that's not how that was supposed to work. So the fact that the bond market has been calm through this period, I think, is a good thing. And it helps quell some of the concerns and worries that I remember when the Fed had to step in and save the bond market because it stopped functioning properly. And they just engaged in market transactions to try to make sure the bond market would function again the way that it needed to. So a calm bond market is a better functioning bond market. There are some dovish things that are likely to be a tailwind for bonds, or can be a tailwind for bonds, maybe through the end of the year, but in 2026 as well. So the end of QT would be dovish for basically a dovish move by the Fed. They don't just have to use rates, they can use their balance sheet. I would expect them to do so. They have overshot on QT before and needed to reverse course, so I see them not making that same mistake this time. So that would be bullish for bonds. We do need to cover our deficit, obviously, but they're likely to issue bills for that and hopefully not affect the long term bond market as much. They're also likely to continue the mortgage runoff, but reinvest that into bills. So they're going to issue bills, but then sort of purchase some of their own bills back. So there's a little bit of a wash that will happen. And then I will not be surprised to hear an announcement about coupons coming down, which would also be bullish for the existing bonds that have higher coupons. So there are some mechanics out there that I think the Fed is going to start to pull different levers to work with financial conditions instead of just rates in the next few months.
The one thing that continues to be flashing, and it's you and Mario did extensive work on this, probably for the first time since we've been talking together, in terms of the amount of depth you went into, and that's obviously the gold market, which, the sell-offs happen, but they are then found by robust moves to the upside. Again, we're sitting here on a Monday afternoon, we're looking at gold up probably close to 3%. And it doesn't, with all the things that we talked about, I mean, it makes sense in the context of some of the leverage problems we're talking about, some of the private equity concerns, but then you juxtapose that with the broader market strength and the relatively calm bond market, and gold shouldn't be doing this, I guess is my point.
No, and it's defied all technicals for a long time, right? All the technicians have been like, time for a pullback. It's way too extended. We're above, I think Dan said last week, 50% above the 200-day moving average. Absurd. Like we're in, I don't know what percentile. If there's more than 100th percentile, that's where
Yeah.
gold is right now. So the technicals aren't working here. And I think we need to probably set them aside for a while because something else is driving this market. We've talked about it for a long time. Last week we talked about it a little bit. I continue to ask myself and ask other people, if there's supposed to be some pullback in gold, who do you think is selling, right? Central banks aren't going to suddenly pivot and unload all their gold. They're sticky. They're keeping that. So that demand is going to stay. I guess retail would sell, the ones that got in the last few months because it finally perked up on people's screens, but that's not going to drive the entire thing down. So who's going to sell it all? And I'm not saying it's going to continue going up this quickly for an extended period of time, but I also have a really hard time seeing a sharp drawdown in gold.
I'm with you, sister. And listen, I'd feel much. How do I put this? I guess I have no confidence in the equity market. I mean, that's clear if you watch me on Fast Money or watch any of our shows. But I would have a bit more confidence in it if the gold market started telling me that I should. And these prices and these price movements, it's not exactly telling me that. But maybe it's decoupled from. We'll see. I don't think that it has, but clearly, at least in this period of time, we have. Let me ask you this.
Well, I'm going to ask you a question
No,
because you're the
go please.
commodities guy. Like, have you ever seen anything this wild before in the gold market?
No, I will tell you there've been days here and there when there've been unwinds of some things. Obviously, there was some times in the silver market where you saw it, but that was not as. I mean, this is a long lasting. This has been working, and you know this. I mean, this has been going in slow motion now for the last 4.5 years. It's obviously accelerated over the last 6 months specifically. But you brought it up. I mean, the fact that central banks are buying at record amounts for the last four, now going on 5 years, suggests something else is going on. This is not a retail driven move. I mean, retail is involved without question, but that's not why the price goes up the way it does. There are other forces at work, and no. So the short answer is, in my career, I have not seen this, especially against a backdrop where historically gold potentially doesn't do as well as it should. So gold is divorced itself. Relationship problems. Gold's in it. It's gotten itself into an entirely new relationship on one of those websites that I don't frequent.
So the naysayers are out today, right?
Of
People
course
out
they
there
are.
saying, "Why would you buy gold? It has zero yield. It has no intrinsic value. It's not as you can't use it like you can use Bitcoin, right?" Everybody's out there poking holes in this. This is whatever. Not something you make money in. Would you buy it today? Like if you're just let's simplify it.
Yeah.
We're all investors. Everybody listening to this is an investor. Your goal when you're investing is to make money, right? I'm not out here to lose money. I'm not out here to stay flat. I'm out here to make money.
If I flew in from Mars and today was my first day on planet Earth, would I? And the answer is no, I would not. And not because I don't believe in the story. I want to be crystal frickin' clear. It's because of what you mentioned earlier in terms of RSIs and percent standard deviations above moving averages. We have never seen this before. We've seen it in some asset classes and some individual names and stocks, but never before in gold, at least none that I can go back and look at. So something's going to trigger a sell-off. It's not going to be central banks. I think it's going to be an equity market sell-off, which gold is not impervious to. That's just
Yeah.
me. So
Yeah.
to answer your question specifically, no, I wouldn't. But I want to emphasize it does not mean that I think this is over by any stretch.
Yeah, it's crazy what's going on. I've said this on a couple of our shows. I had been in gold for a long time in all the ways, right? I was in GLD, I was in IAU, I was in PHYS, I was in the miners for a long time. And then in April, I sold it because there were such good gains and it felt like I
Yeah.
think we squeezed it all out, right? And we had the big volatility moment. I sold it all. And then it kind of went sideways. And then once it started rising again, I was like, oh my gosh, I got to get back in. So I started to get back in mid September and then bought up until very early
And
October.
you did it exactly
And
right. I mean,
I mean, I'm not up as much as I was in the previous position, but I'm still up about 11, 12%. I mean, which is crazy. It's
it's
been a month and a
remarkable.
half. Like
Yeah,
not even a month and a half. It's been a
it
month.
doesn't it shouldn't work like this, but
Right.
here we are. So in the last couple of minutes, we're supposed to get CPI on Friday, and we've talked about the reasons why. The reason I believe it is because Social Security payments or Social Security metrics are reliant upon CPI as the inflation gauge to tweak these things. I think that's how I understand it. So you're getting it on Friday. My question to you, I guess, is is the market going to look? Is it important?
I don't think it's going to be important this Friday unless it's some kind of surprise. But I mean, we're going to get it almost at the end of October for September. Now we're on to what's happening in October, and really everybody's focused on the labor market anyway to move the market. And the Fed is clearly going to look at this. So now we'll have some clarity into what the Fed is going to make their decision on next week, but we don't have the labor data. And that's what we really want. So I don't think it helps us feel any more certain or any more clear about what's going to happen with the Fed for the rest of the year. And again, unless it's a big surprise, I don't think it's going to do much.
She's Elizabeth Thomas of SoFi, along with her. I mean, your partner, but your work colleague,
My
Mario,
colleague, my counterpart,
colleague. Yeah,
my partner in crime.
counterpart. I loved it. I met him at the
Uh-huh.
last Fast Money Live event. Gentleman, he came up. I was thrilled to meet him. Love the
Yeah.
work that you do. We are fortunate, as you know, to have you join us. I love doing this because it's just the two of us. We don't have to listen to Dan opine on things. I hope he's stuck around for that. We'll see you soon, folks. Thanks for joining.